Who would have thought? We finally have some competition in the FTSE All-World Index, my personal favorite way to easily invest into thousands of stocks from all across the world. Last month, another well-known and experienced fund provider, Invesco, joined the party by launching the Invesco FTSE All-World ETF in both the distributing and accumulating version. But that's not the exciting part. Invesco decided to rock the boat by launching its ETFs at a significantly lower total expense ratio, 0.15% compared to Vanguard's 0.22% per year. It may not look like much, but in percentage terms, that's a 32% reduction in fees, which is quite significant. As a result, you might be wondering if buying Invesco's ETF is now the better option. So is VWCE and Chill still a viable investment strategy for stocks? By the way, can you imagine wearing this shirt on a date? Someone's definitely getting laid. Or will all the cool kids start saying FWRA and Chill soon? Let's take a closer look and find out. First of all, why has the Vanguard FTSE All-World become so popular among European investors? Well, it represents an easy, passive and inexpensive way to invest into a grand total of 3,686 stocks from all across the world, weighted based on each stock's market capitalization. And it doesn't only contain developed markets like you would find in the MSCI World, for example, but also emerging markets like India, China, Taiwan or Brazil. As a result, no matter where the best publicly listed companies come from in the future, we're able to get our share in their growth and profits. Thus, many investors consider this to be the easiest way to invest long term, while keeping things as simple as possible, as you just need a single ETF to diversify your investment within the global stock market. And Vanguard's Accumulating FTSE All-World ETF, the one my wife and I buy on a monthly basis, has enabled us to do exactly that for a few years now, while charging low fees in form of a total expense ratio of only 0.22% per year. In case you're wondering, I usually buy it using my favorite low-cost broker in Europe, Interactive Brokers. You can find it linked down below in the description in case you'd like to support me. And while you're down there, don't forget to subscribe if you haven't already. We're so close to 20,000 subscribers. Okay, getting back to topic, some of you might be wondering what a total expense ratio, in short TER, is in the first place. It represents the total cost associated with managing and operating a fund. In our case, we're talking about ETFs that passively track an index, which is why expenses are kept to a minimum. But that's not the full story. We also need to take a look at the tracking difference, meaning how close an ETF is able to replicate its benchmark, so the index performance. And the best ETF providers, Vanguard being one of them, managed to perform even better than their underlying index in some years. There's a great site called trackingdifferences.com which looks at just that. Here I'm showing you the distributing Vanguard FTSE All-World ETF, since it has a longer history than the accumulating version. You would expect to see a tracking difference of at least 0.22%, which is its total expense ratio, and yet it's minus 0.02% on average since 2013. As the website points out, the ETF was less expensive than the TER suggests and even exceeded the index performance. So it's basically as if you didn't pay any fees to the fund provider Vanguard at all, which is fantastic. So while at first glance the 32% lower total expense ratio of Invesco's new FTSE All-World ETF looks better compared to Vanguard's 0.22%, now you understand that it's not the only thing that matters. The actual tracking difference, so how closely an ETF is able to track its index over time, is way more important, and we simply don't have that information yet for Invesco's new funds since they were just launched. Speaking of that, there's another important factor to consider: an ETF's fund size. Since Invesco's ETFs have just been launched, their fund size is still tiny at only 7 and 1 million euros respectively, according to Just ETF. If the funds remain relatively small, for example below a fund size of 100 million euros in a few years, they're at risk of being dissolved, since they need to reach a certain size to cover the costs of operation. Now, fund liquidations in themselves are not a big deal. All the stocks within the ETF are sold, after which each investor gets the value of their ETF shares paid out to their account. However, this can come with other negative implications. From a taxation perspective, this is counted as if you had sold your shares. This means you now have to fully tax any capital gains you generate from this ETF position already in your country of residence, instead of, for example, later in retirement when you actually need the money. As a result, after taking taxes into account, you now have less money left over working for you when you decide to move it into another ETF. Now, compared to Invesco's minuscule 7 and 1 million euro fund sizes, Vanguard's two ETFs have 6,800 million, so 6.8 billion euros and 10 billion euros in assets under management respectively. At that size, they're unlikely to ever be liquidated, making them the far safer choice for the long run at the moment. The fact that the new ETFs have a significantly smaller number of investors and thus less liquidity is also reflected in spreads when buying and selling shares on exchanges. You generally want these spreads to be as low as possible. That way you ensure you're not overpaying when buying and not getting less than your shares are worth at the point of selling. Based on my research over a few full trading days, Invesco's ETFs still come with a much higher average spread of between 0.18 to 0.26% on the largest European exchanges, compared to only 0.02 to 0.04% on average for the Vanguard counterparts. Again, Vanguard wins this round by a large margin. This brings me to my second to last point, availability. If you're a long-term investor like me, you probably want to regularly invest into your ETF of choice as easily as possible while keeping fees to a minimum. So let's have a look at the situation using my two favorite low-cost brokers right now. I'll link them down below in the description in case you'd like to check them out for yourself and support me. You can also find the ETF's ticker symbols there. Starting with my personal number one, Interactive Brokers, where you're of course able to find and directly buy the new Invesco ETFs as either the accumulating or distributing version, and obviously both Vanguard ETFs, with the one I buy every month being the Accumulating Vanguard FTSE All-World, aka VWCE. On Interactive Brokers, the two Vanguard ETFs come with two recently introduced features that are currently still missing from Invesco's counterparts. You can buy fractional shares as well, not just full shares, meaning you can fully invest whichever amount you want to put to work, and you can set up recurring investments to automatically invest some money into the Vanguard FTSE All-World at regular intervals. That's exactly what I'm doing as well. You can watch this recent video of mine next if you'd like to see exactly how this works. Meanwhile, all four ETFs can be found on another excellent low-cost broker, Trade Republic, as well. And here you're not only able to set up saving plans for Vanguard, but also for Invesco's new ETFs already. I'm actually impressed that they were added to their free ETF saving plans already. After all, they were launched less than 1 month ago. Anyway, now that we spent some time taking a closer look at the ETFs, let's get back to the question we asked ourselves in the beginning. Are Invesco's FTSE All-World ETFs now the better option compared to Vanguard because of their lower fees? If you watched the entire video, you can probably guess that my answer is no. Still, here's a short recap of my top 3 reasons why. First, the total expense ratio isn't the only thing that matters. The tracking difference is a lot more important. Here, Vanguard has done an excellent job so far, and we still need to wait and see how Invesco will perform in this regard. Second, the Invesco FTSE All-World ETFs only have a tiny fund size right now. I think it makes sense to wait until they reach at least 100 million euros in assets under management to reduce the risk of the funds being liquidated due to them not being able to cover their costs of operation yet. Meanwhile, Vanguard's two ETFs have billions in assets under management, so this is not an issue. And third, due to much lower liquidity, the spread between buy and sell prices for Invesco's new ETFs is almost 10 times higher right now compared to the popular Vanguard ETFs. As a result, you may end up paying a bit more than you should for your Invesco FTSE All-World shares. That being said, there's still reason to celebrate. The fact that Invesco launched these competing ETFs is great for us investors, as it drives costs lower over time. I actually reached out to Vanguard to ask about their future plans regarding their All-World ETFs. While they couldn't give me an exact timeline, they did mention that they will reduce its total expense ratio further over time. The last time they reduced these ETFs' fees was in October 2019, when they reduced it from 0.25% to 0.22% per year. So who knows, perhaps we see another update this October already. But that's not all. Invesco wasn't the only fund provider putting some pressure on Vanguard this year. State Street also massively reduced the total expense ratio of its SPDR MSCI All-Country World Investable Market Index ETF from 0.4% to 0.17% a few months ago. The MSCI All-Country World Index IMI is another index that's very close to what the FTSE All-World covers, while including more small-cap stocks. Its performance has been almost identical since 2015. Thus, it's another excellent solution to invest into the global stock market via a single ETF. Because of its age, size and higher liquidity, leading to tight spreads of only 0.05%, I actually consider this to be a much better alternative to Vanguard's FTSE All-World than Invesco's new funds right now. Just be aware that it's only available as an accumulating version, which automatically reinvests dividends into more shares of the stocks within the index. And that pretty much concludes what I wanted to talk about today. Personally, I don't see any reason to change my one ETF strategy anytime soon. It's still VWCE and chill for me as well as my wife. But how about you guys? Let me know in the comments below. Before you take off, don't forget to subscribe so you don't miss any upcoming videos. I have big plans for the rest of the year, and we're so close to 20,000 subscribers right now. I created many other videos that might be useful to you if you're new to ETF investing, so make sure you check out this playlist if you haven't seen them yet. Thank you so much for watching, have a wonderful day, and until next time.